Hi, I'm David Witter, founder and CEO of Financial Harvest Wealth Advisors. Great to be with you today. Glad you're joining us. And what we're going to talk about is the markets seem to be soaring, 8 quarters of positive returns. What should we be focusing on now to maximize our success? So let me start with three common themes or focuses that I'm hearing from the marketplace. And then we'll go into a little bit of depth with each one of those. So the first one is that dumb money is what's driving the markets up, kind of like in the late 90s, people chasing after the technology boom. Second is what to do with the big five technology companies, Apple being the largest, kind of driving high returns here this year. And then third is this notion of like, hey, we're at all-time market highs. Doesn't that mean we should be looking for or anticipating or more likely for a big correction that will affect the returns going forward? So let's look at these individually. Let me start with dumb money. In the Saturday edition of the Wall Street Journal, this was written by Jason Swig talking about the market being different this time. And what he brought up was that over the last roughly 2 years during the rise in the markets, there's actually been net outflows from equity mutual funds and net inflows into fixed income or bond funds. Now, why is that important? What that's showing us is that people on average or as a whole are pulling money out of stocks and then they are generally adding that money back into fixed income. Well, the reason that's going on is because people tend to be rebalancing as they're working with fiduciary advisors, selling out of equities, buying into fixed income to bring it back into target. That's an argument for why maybe this isn't dumb money driving the markets higher, because people with investors working with fiduciaries are being more responsible with their portfolio design. The second narrative that we're seeing a bit is what to do with these technology, the big five. So the big five are Apple, Google, Microsoft, Facebook, and Amazon. These five companies in particular year to date have really been driving high returns, especially on the Dow and the S&P 500. Now, believe it or not, these five technology companies now represent almost 14% of the market capitalization of the S&P 500. That means if you dropped in, let's say $100 in an S&P 500 index fund, that means out of those $100, 14 of those dollars would be invested in these five big technology companies. Is that prudent? I don't know. Here's another article from the Wall Street Journal this past Saturday. It was titled, Why It's Time to Dump Apple. Not giving investment advice here, but this was an interesting conversation. What the author pointed out was that if you invested in the highest market-weighted capitalization stock, in the S&P 500 over time, going back to 1974. That could change over time. Might have been ExxonMobil, IBM, most recently here Apple. What they plotted here was in pink, what was the return of the highest market capitalization of the biggest company in the S&P 500 versus the S&P 500 index as a whole. So you can see the index as a whole dramatically outperformed just owning that one individual large cap or the largest company stock. This is an argument for why you'd want to diversify maybe away from those big five technology companies. Now, let me speak to my clients here. You do own those five companies, but we tend to weight your portfolios maybe a little bit more towards small cap, a little bit more towards value companies to get broader diversification and take away some of that volatility that can be experienced by these big mega cap companies. Third thing we're seeing is, oh gosh, we're at all-time market highs. What should we be doing with that? Is this the time to maybe move out? So here we pulled data for 1,091 months, almost 1,100 months, from January of 1926 to the end of the year 2016 for the S&P 500. Notice that out of those almost 1,100 data points, 319 of them were all-time market highs. Pretty common occurrence, in fact, 30% of that. The next thing we looked at, though, is during that same time period, during those 1,100 months, give or take, what happened after an all-time market high. So what we did here is after a month where we had an all-time market high, what was the return of the index 1 year later, 3 years later, and 5 years later? Notice here that the average return 1 year later is almost 14% higher, 3 years later up 37, 5 years later up 64. And that occurrence was somewhere around 80 to 84% of the time. The index was higher after an all-time market high. What does this mean? The dominant strategy is to invest and stay invested, because even after an all-time market high, those are very compelling returns shown here by the index. So in conclusion, what is the dominant strategy? Number one, know your plan. Sometimes it calls for rebalancing. Stick with it. Work with your fiduciary advisor. Number two is weight your portfolio prudently. It may not be the best move to have 14% of your large cap allocated to just 5 technology companies. And last but not least, invest. The dominant strategy: invest and stay invested. If we can help you with your plan and with your waiting and also staying invested, let us know, and I look forward to speaking with you soon.